Hello, welcome to Capital Market Live on Channels Television. I'm Ladi Williams. A lot has happened in the markets and the corporate world this past week, and it's time to highlight the most important ones, starting with the markets now. European stocks closed slightly high on Friday following a better-than-expected U.S. jobs report. DAX rose by 0.3%. However, the FTSE and CAC declined by 0.03% and 0.02% each to close the week. Eurozone producer prices gathered pace in May on the back of rising energy prices, while factory gate prices across the 19-member common currency bloc rose 1.3% month-on-month and 9.6% year-on-year. On Thursday, following 2 days of talks, 130 countries pledged support for the U.S. proposal of a global minimum corporate tax of 15%. And over to the Asia-Pacific, where mainland Chinese stocks were among the biggest losers, and regionally as the Shanghai Composite fell 1.95%. Similarly, Shenzhen Component dropped 2.44%, while Hong Kong's Hang Seng Index declined 1.8% to close. Elsewhere, the Nikkei 225 in Japan nudged up 0.27% to finish the trading day. And over to the U.S. now. Stocks rose on Friday, and S&P 500 hit another record high after June jobs report showed an accelerating recovery from the U.S. labor market. The broad market index rose 0.75%. The tech-heavy NASDAQ Composite climbed 0.81% to touch its own 52-week high record, while the Dow Jones Industrial Average added 152.82 points to close. The S&P 500 has now risen for 7 consecutive sessions, its longest winning streak since August. For the week, the NASDAQ Composite rose nearly 2%, while the S&P 500 and Dow climbed 1.7% and 1% each. Strong week on Wall Street was spurred by a string of solid economic activities capped by a better-than-expected jobs report on Friday, as the economy added 850,000 jobs last month. According to the Bureau of Labor Statistics, economists were expecting an addition of 706,000 jobs. However, the print topped the revised 583,000 jobs created in May. Meanwhile, the U.S. market will be closed on Monday for the July 4th holiday. And back home, the Nigeria stock market ended the week in the positive territory as the NGX All-Share Index and equity cap grew by 1.47% and 1.49% each, after 2 consecutive bearish weeks. The uptick in the all-share index moved the benchmark index up to 38,000 level again, and 4 out of the 5 key sectors of listed equities recorded gains, particularly the consumer index, which rose by about 5%, while the oil and gas counter was the lone loser with that chart. The trio of GT Holdings, Wema Bank, and Zenith Bank were the top 3 most traded stocks for the week. Meanwhile, the volume of shares traded within the 5 sessions was higher by 1.5% in contrast to the previous week, as about 1 billion shares changed hands for 14.14 billion naira in over 17,500 transactions. Joining us now is Professor Uche Owaleke, Professor of Capital Market at Nasarawa State University. Professor, thank you for joining us.
Thank you very much, Ladi. It's my pleasure.
Great to have you. Well, you know, let's take stock here. The equities market has shared 1.303 trillion naira in the first half of 2021. That's not a good number.
Thank you, Ladi. The market, that's talking about the equities market, lost about 6% in the first half of 2021. Ladi, I don't know whether you read an article I did sometime in January, which I titled Crystal Guessing the Stock Market in the year 2021. And in that article, I had predicted, and rightly so now, that the market was going to do a pullback against the backdrop of the performance, the unexpected performance we had in 2020, especially towards the end of 2020. You will recall that the equities market in 2020 was adjudged the best in the world in terms of performance, returning over 50%. So against that backdrop, I had said that a lot of corrections will be taking place, especially in the first half of 2021 for obvious reasons.
Oh, spot on.
The equities market, as you may know, is one market that obeys the laws of gravity. You know, is one market where whatever goes up, has to come down. So it's not surprising that has happened. And again, if you recall, the major factor that brought about the bullish performance we had in 2020, again, especially towards the end of 2020, the Q4 of 2020, had to do with the deliberate low interest rate regime environment that was engendered by the Central Bank of Nigeria. The Central Bank of Nigeria had policies that tended to inject more liquidity into the system, and of course more liquidity meant interest rates came down. Talking about the loan to deposit ratio of the central bank, talking about the differentiated cash reserve requirements, and also talking about the reduction in the monetary policy rate we saw in September 2020, to 11.5%, which is still what is prevailing. So all of that crashed yields, in the fixed income market, and so naturally, of course, we saw portfolio rebalancing in favor of equities. So equities surged, and we had that performance. Now, this situation, is beginning to reverse. So if you talk about the factors responsible for the depreciation we saw in the equities market in the year 2021, first half of 2021, the chief culprit, in my view, has to do with the rising yields in the fixed income space.
Right.
So again, so we're also seeing, investors shifting preference for fixed income for obvious reasons. Fixed income, of course, are senior securities in the sense that they are also considered safer, safer asset classes relative to equities. Now, the other factor, has to do with the overall macroeconomic environment. Of course, the market is not detached, it's not delinked from what happens in the economy. The first is inflation. You notice that in the last, especially between January and April, we saw rising inflation rate. Even as we speak, inflation is still elevated, quite elevated at 7.93%. So a situation where you have rising inflation, does not augur well for the equities market, for investments generally, because any investor will be interested in, getting returns that are positive, real returns that are positive. If inflation is rising, and you are having returns that are below inflation rate, of course, that's a disincentive, for investment. So rising inflation is not in the interest of equity investments. The fact too that we had issues with naira devaluation, so to speak, is also a factor, because when you have a situation in which the exchange rate is unstable, for example, and there is an expectation of a devaluation of the naira, so you now tend to see people trying to now even do currencies. You see them taking currencies as a store of wealth. So that is also something to consider. So rising inflation, the exchange rate situation, in spite of the strong oil price that we've had. Of course, the external reserves have been depleting. As of the 30th of June, we hear is about $33.3 billion.
Exactly.
So these indicators are not helpful for the market. The other two, it has to do with the Purchasing Managers Index, LADI. Purchasing Managers Index has again also slipped into the slipped below the threshold of 50 points. So it's underwater.
Professor.
So if you look at these macroeconomic factors, they are not favorable for equities investment.
Yeah, but very quickly, what's your outlook for the next 6 months?
Well, I am very positive and very optimistic. The outlook is bright, but we may not get as much as we had in 2020. But the good thing is that the negative trend, is likely to halt before the year runs out, and that is going to be, brought about by maybe stability in the macroeconomy. We are beginning to see inflation trending down, and I hope that is sustained. And the central bank, if my reading is correct, is not disposed, to implementing, as it were, a contractionary, monetary policy. Central bank is still favorably disposed towards, supporting growth. So as long as it continues to pay more attention to this, growth recovery efforts and initiatives, more than the, issues around inflation, I think the system will continue to have, liquidity that will sustain, the interest in the equities market. So I think it is going to be bright, especially against the backdrop of the fact that in recent times we've seen strengthened regulation, particularly on the part of the Securities and Exchange Commission, that is the Apex regulator. In recent time, the Apex regulator has registered not only digital trading platforms such as Cowrywise and Chaka. The SEC has also registered even derivative contracts. Recently, they registered 7 derivative contracts talking about the index options, the NGX 30, index option, as well as stock futures on Zenith Bank, stock futures on GTB, stock futures on Dangote Cement, and Access Bank, and the rest. So these are positive signals, for the market in the second half of 2021. And again, I must mention too, a number of companies have released their forecasts, for the period ending 30th of September. And if you look at those forecasts released, which you can find in the website of the Nigerian Exchange, you realize that many of those forecasts are quite an improvement over what we had in the previous quarters. And so if we go by that, I want to believe that company fundamentals will be stronger, and that should drive the recovery of the equities market. But let me also say this, Ladi, that is an advice I want to give the exchange at this point. If you look at the earnings forecast submitted by companies, if you're looking at them, you don't tend to see any uniformity in the template or format of what is submitted. Okay, some companies, for some companies, you just find one page, without notes, and some other companies you find, some level of information that's also accompanied by notes. So apart from saying you want to show your forecast income statement, for example, your forecast statement of financial position, your forecast cash flow, there is need to have the notes and the assumptions that accompany that. So it's a situation in which you find just the maybe forecast income statement, and that's all that is submitted for a company. I don't think it helps disclosure. So there is need to harmonize and streamline, and possibly recommend a standard template that all companies should use to submit their earnings forecast. Well, that's as an aside. But as I said earlier on, I am very optimistic that the second half of 2020 will be a lot better than what we saw in 2021, rather, than what we saw in first half, yes.
Professor, how can investors, get maximum value from this asset class?
I want to commend both the Nigerian Exchange and as well as the Securities and Exchange Commission, for making that happen. Earlier on, I had alluded to that. I had mentioned that for me, that's a major development because this is one market, of course, that needs a lot of product offerings. Significant progress has been made in that regard. I must mention. It used to be just equities and bonds, but today we talk about ETFs. We talk about that's exchange traded products. We also talk about REITs, and today the menu of asset classes is being increased with the registration by the SEC of this derivative contracts. Of course, that will offer investors a wide array of opportunities for diversification, and more importantly, opportunities for hedging. Derivatives are, if you like, products whose value are derived from the values of the underlying assets, and they are primarily used to hedge risk. Of course, if you are investing, risk is a major consideration. So when you have a product that allows you to hedge risk, okay, for a risk-averse investor, that draws the investor to the market. Someone that would ordinarily, not want to play in a highly volatile market would now want to come because of the instruments that are available to hedge risk. And it's also positive for our market because it has the potential to also attract more investors in our market, especially foreign investors who are, sophisticated investors. And like as you know, as we speak, domestic investors have continued to, dominate the market. In the last 6 months, domestic investors have accounted for about 60% of transactions that are, done in that market.
But is there still room for improvement regarding domestic investors?
Oh, absolutely. Absolutely room for improvement. Room for improvements. Look at even the current efforts now by, again, the SEC's subsidiary, the training arm of SEC, known as the Nigerian Capital Markets Institute, is currently being restructured, to play that role, the role of leading the, if you like, the sensitization of the bulk of potential investors out there on the benefits of investing in the markets. And if that happens, you will agree with me that the base of retail investors in Nigeria will increase, because that is what we require. We require to increase that. I was just mentioning that domestic investors have helped to support this market. But for domestic investors, we would have been in trouble even in 2020 when foreign investors exited. And as we speak, I don't see them coming back to Nigeria anytime soon, as in the foreseeable future. And that's because of even the conditions that are available in their own countries. We hear that the Federal Reserve of the United States, for example, is beginning to toy with the idea of normalizing interest rates. Interest rates in the U.S., if you use the benchmark rate by that's the Fed fund rate, which is at near 0%, between 0 and 25%. Okay, so the Federal Reserve plan to normalize interest rates and increase interest rates with a view to even achieving a higher inflation rate target, will usually swing investors' interest, more in that area. So we may not see them coming back soon, and that's why we will have to encourage our domestic investors, to play more in this market.
All right, Professor, let's look at market capitalization now. How relevant is this market cap to investor behavior?
Okay, when you say market cap for a company, market cap is the product of the price of that company and the number of outstanding shares. When we mean outstanding shares, we mean shares that the company has issued. So that is the market cap, okay? And if you talk about for the entire market, when you have market capitalization for the entire market, it is the aggregation of the market caps of all the companies that are, listed, on the exchange. So that is total market cap capitalization. For an individual company, for example, as I said, it's a function of price and outstanding share. How is it relevant to an investor? I want to use an example. The more a company shares, the more the number, okay, the less you would expect to get in terms of dividend per share, because dividend per share is dividend divide by the number of outstanding shares. So if you have two companies A and B, they have the same earnings, and we also assume they are paying out the entire earnings as dividend. Company A has more outstanding shares than Company B. You would expect that the dividend per share in Company A will be smaller than that of Company B. So an investor should also be watching out for such things. Take the banking sector, for example. Zenith Bank has about 31 billion outstanding shares, and Zenith Bank at currently 24 naira, will give a market cap that is a product of 24 times the 31 billion. Okay, and you take another company like Stanbic IBTC. Stanbic IBTC at 40 naira per share, now has outstanding shares of just 11 million naira. So you would expect that if these two companies have the same earnings, that dividend per share of Stanbic IBTC will be higher. So that is the information content that market cap sends out to investors. So it's important.
But what would you say is the best portfolio mix? Considering the different market cap levels, from the micro caps, mid caps, and the bigger caps. What would you say is the best mix in a portfolio?
Yeah, the best mix, speaks to, diversification. Having a number of securities that are, as we say, negatively, correlated. Okay. So it's not just about the size, but it's also about the performance. So if you have a company whose earnings, is quite high, okay, of course, for such a company, you would also expect, especially if it's a company with a track record of dividend payment, you would expect that, the dividend per share or the dividend yield is the dividend divided by the market price of the share, will be high. Don't forget, too, that investors after two things, basically, when you talk about returns, is either price appreciation or dividend. So any investor going into the market should keep track of a company's performance in terms of these two. And that's what we'll talk about, the company fundamentals. Company fundamentals will refer to issue. We discussed it on this program, some time ago.
Right.
Has to do more with a company's earnings, and that's also tied to the index. You talked about market cap. One can also mention the index and its relevance to investors. Well, market index is just an indicator of market performance. For the NGX All-Share Index, note that I didn't use NSE All-Share Index because of the recent rebranding. So the NGX All-Share Index, yes, it tracks the movement in the prices of all equities listed on the Nigerian exchange, including those on the growth board. On the growth board, we have about 9 of them. So we'll have the premium board, we'll have the main board, and we'll have the growth board.
Professor, I'm so sorry, but time is up right now. Thank you so much for your time on the program. We'll continue this conversation another time. Professor Uche Nwaleke is Professor of Capital Market at Nasarawa State University. Thank you so much.
My pleasure, Ladi.
All right, and that's it on the show for this weekend. Thank you for watching. I'm Ladi Williams. I'll see you next time.